Hello my dear students, in this video I'm going to give a brief overview for Unit 2. In Unit 2, we have one learning goal, which is understand how financial statements and ratios and basics tax fundamentals impact the financial planning process. In other words, we studied financial planning process, financial statements, ratios, and tax in this unit. Let's start with the steps in the financial planning process. First, you determine your life goals and then determine your financial goals. Your financial goals should be dependent upon your life goals, not the other way around. Second, evaluate your financial health. Third, develop a financial plan. Fourth, implement the plan. Fifth, keep tracking your financial situation using the financial ratio. Sixth, modify your plan accordingly if necessary. When you are making a goal, make sure you make SMART goals. First, your goals should be specific. We want to know what exactly you want to achieve. If you want to live a better life, define a better life. Do you want to buy a nice car or a nice house? Be specific. Second, measurable. How much will it take for a nice car or a nice house? Third, achievable. Is it possible for you to earn enough money to buy a nice car or a nice house? Fourth, realistic. If you can earn enough money to buy a nice car or a nice house, will you still have anything left for basic living expenses after you buy a nice car and a nice house? Fifth, timely. When do you want to buy a nice car and a nice house? Now, let's talk about personal financial statements. The two major financial statements in the personal finance field are balance sheet and income statement. A balance sheet shows your assets and liabilities at one point of time. Your assets are what you own, your liabilities are what you owe. An income statement shows your income and expense during a specific period of time. For an individual, incomes and expenses are typically cash inflow and cash outflow. And therefore, an income statement is also known as cash flow statement or the income and expense statement. After you figure out how much assets and how much liability you have, you can calculate your net worth by subtracting your liability from your assets. Your net worth shows you how much money you have left after you sell out all of your assets and pay back all of your liabilities. If you have a positive net worth, you are known as solvent. If you have a negative net worth, you are known as insolvent. With an organized financial statement, we can analyze one's financial health using financial ratios. We learned living expense cover ratio, which measures how many months you can live without income. Debt ratio and asset to debt ratio measures your solvency. Debt service to income ratio measures whether you are having a heavy debt load. Saving ratios measures your degree of saving. Investment assets to total assets measures your degree of wealth building. Finally, tax. In this unit, we learned how to calculate tax. A very important concept here is the marginal tax rate. Look at the tax table here. The tax rates in the green box here are the marginal tax rates. Marginal tax rate is the tax rate you paid on the next dollar you make. Be aware that this is not overall tax rate. Even if you are in the highest tax bracket, say the 37% tax bracket, part of your incomes are still taxed at 10%, 12%, 22%, 24%, 32%, and 35%. Make sure you know how to calculate the tax amounts and the difference between effective tax rate and the marginal tax rate. In order to calculate your tax, first you will need to calculate your taxable income. Here are the steps to calculate your tax amount. First, you need to determine your total gross income. Second, you calculate your adjusted gross income, or say AGI, by subtracting adjustments from your gross income. Adjustments are also known as above-the-line deductions. Step 3. Calculate the below-the-line deductions. Here, you can choose either to deduct a standard deduction or an itemized deduction. You cannot deduct both of them, so choose the larger of them to deduct. Be aware that both the standard deduction and the itemized deductions are a below-the-line deduction. Do not confuse below-the-line deduction with adjustment, which is known as above-the-line deduction. Step 4. You calculate taxable income by subtracting below-the-line deduction from your AGI. Based on the taxable income, you can find your tax liability. Step 5. Calculate your extra tax liability by subtracting tax credit from the tax liability you just found. Finally, this is the amount of tax you need to pay. These are all I would like to cover in Unit 2 overview. Please feel free to reach me if you have any questions. I will see you soon in Unit 3.